Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today is moving day in the market with a lot of the things that we've been talking about over the last couple of weeks kind of culminating right now. So when we look at what we're going to talk about today, we're going to look at obviously the Primary Vision Frac Spread Count. We also want to look at what is happening with gas oil storage, distillate storage, and natural gas. Because when you look at everything that is happening in terms of natural gas moves in both Europe and the US, and if you remember back on the Econ show yesterday, in segment one, which I think is probably the most important segment of that grouping. Obviously, they're all important in my opinion, but that one is the one where we cover a lot about the electricity shortages, how it's happening in so many different places. And just now there was another independent consulting firm coming out saying that this will be the smallest US corn crop since 2019, signaling higher food costs ahead, which is again what we've been talking about coming into this point. Looking at corn, obviously beans as well as wheat. So there's a lot of commodity issues that we've been talking about: electricity, natural gas, oil, obviously all of these pieces where even as demand falls, you still have that supply uncertainty, which is keeping those rates elevated. Electricity going parabolic again in Europe and creating a lot of these, again, the input costs that keep coming up. So we'll talk about that throughout this segment. So now looking at the U.S., the Primary Vision Frac Spread Count, we went up by 7. So if you remember last week, we were talking about the conversation I had with our CTO and how I thought we were going to start seeing an increase earlier. Instead, he was saying, look, based on the data that's coming through, it's really going to be this week. And here it is, going up by 7. So we're closing out August strong, and sets us up well as we go into September to see that push to about 300, 305, which is where we really think we're going to settle out as we make that final push through September, October, until we get that normal decline as we go into November, with the biggest increases again happening in some of the smaller basins and as well as in the Permian. So again, we're going to continue to see that. Not a huge surge. Again, we're talking 13, maybe 17 spreads. We're not seeing this huge like, oh, we're going to bring back 30 spreads. No, that's not the case that we're living in. But when we start talking about storage and some of the key drivers, that's going to continue to be a positive when we're looking at some of these moves, especially on the natural gas front, when we compare what's happening in Europe versus what's happening in the US. On the rig front, a small increase up by 3 for oil, down 1 on gas. But when we always like to look at what type of rigs, because here you can see horizontal rigs just held steady. So horizontal rigs still not too much. So this is where rigs settle out a bit and you get a little bit of a catch up on the frac spread count side. We do think rigs will continue to grind higher on the horizontal front while spreads go up. But again, it's just the spreads still have a ways to go to catch up to where we are, because typically we're at about a 0.41 spread of rigs to spreads, and right now we're at about a 0.37. So again, there's still some of that move higher that we can get because rigs have moved to such a level. But again, horizontal just going sideways, 1 directional, 2 vertical. The 2 verticals usually pretty good of an indication of horizontal coming back up. So we're going to see these moves, which is going to support that duck count for that push as we go through September and October. Now, when we turn to refined products, here you can see there was a massive build in Singapore, and that was driven based on light distillate, aka gasoline, as well as residual fuel. Those are the 2 pieces. So when you look at light distillate, back to all-time highs. Residual fuel, as we said on Wednesday, we were going to get back to essentially flat for the average, but middle distillate went down again. So that's what matters the most when you're looking at diesel and those underlying prices. That's where we continue to see that the problems when you look globally. While light distillate gasoline, there's a lot of gasoline in this world. It's just a matter of where does it sit. So when you look at the East Coast, yes, the East Coast is light, but there's more than enough to import. It just doesn't make economic sense to import it at this point in time.
So when we now turn down to what's happening in Europe, you can see that there were builds in across the board except for jet. Gasoline went up by 151. So now the gasoline inventories in Europe are back to all-time highs, taking out the 2020 highs again. So gas oil had a decent build of 183, but when you look at the builds, which we'll show in a second, you're seeing that it's still so far off of where we need to be, with the expectation that we're going to see about 450,000 to 650,000 barrels a day of additional demand from gas to oil switching, as well as people who are purchasing diesel backup generators. You know, the concern about are there going to be blackouts or rolling brownouts, and what is that going to look like as the panic really kind of sets in as people prepare for winter, because you only have so much time for that preparation. But again, Singapore is continuing to scream that problem that we've been talking about on gasoline, because when you make diesel, you inherently make gasoline, and that just means that the middle distillate crack has to carry the light distillate crack, because the light distillate side, especially the gasoline side, will go negative, and you need to see middle distillate high enough to offset that, keeping those prices elevated. Putting into context, obviously, European gas oil storage, we did get a build, but you get an idea of just how low it is. So the rate of change still has to accelerate extensively to get even to the lower end of where this is. And this is going into what is a very big concern, which is obviously winter. Now, when we look at European natural gas storage, you can see that it is well above the 11-year average, but you have to put that into context, because yes, it's higher, but typically, and this holds true to propane, natural gas, if you get a massive polar vortex, you can burn through 10 days of coverage in 3 days. And so the longer that happens, the quicker you can draw down a lot of this storage. And it's not like Europe can just call up Gazprom and say, hey guys, can we buy some more? And is there going to be enough LNG in the market to support if you drain down storage quickly because you have a cold winter, because winter starts earlier? So that's why, even though storage looks normal, there's still that uncertainty, because we're heading into shoulder season. Can they get enough? And realistically, will there be enough LNG to maintain normal flows? Because when you get towards the end of November, December, January, February, these draws also factor in that you're also taking in normal inputs from piped gas. So as you lose that piped gas, will the rate of change be much sharper? So you have to start from a higher level, because you're going to finish out at a lower level. And again, these are the things that are being weighed when we look at what's happening in Europe. Now, from a U.S. perspective, this is the third lowest we've ever been, going back the last 11 years. So we're at the same level we were at in 2014, well below the 11-year average. And this is driven based on, a little bit slower on supply. And again, we have a record amount of natural gas going into, natural gas going into LNG, and we just have higher demand internally. So you have higher demand, supply that is, not much up or down. And then you have LNG. So even if supply stays flat, you have demand going up internally, internationally, which again is keeping us at a very low storage number heading into shoulder season, which again is going to support the curve. It's going to support Henry Hub where we are. And that's what we're seeing here. Now, to put into context the export market, so Freeport, based on these metrics, are exporting about 0.4 million metric tons. So when you look at that level versus what they're normally doing of about 1.4, so they did slide back from October to November on when they can bring back 80% of their production. So they're saying November now for 80% of production, and the remaining 20% by March of next year. But even with Freeport down, the U.S. is still exporting 6 MTPA. So when you're looking at this, you're like, all right, well, there's still that LNG going into the market. There's still that natural gas, because Europe's a buyer, and anybody's a buyer who can afford it.
And because LNG is so expensive due to European buying activity, you're seeing that pivot where some countries just can't afford it. Now, back to the point that we talked about with the U.S. at the lowest U.S. corn crop since 2019, soaring gas prices are hitting fertilizer and European fertilizer and chemicals. 70% of fertilizer capacity has been cut in Europe. This is terrible when you're thinking about the availability of fertilizer for farmers, because is it going to be available next year? How am I going to plant my winter crops? Can I get enough lined up for next fall? I'm sorry, next spring. These are some key components that are a huge overhang, as well as the petchem side. So where are they going to get petrochemicals? Is there, obviously demand's coming down. We've been talking about how the world is in contraction, but even as demand falls, you're watching, again, petrochemical volumes fall, supply fall. So that, again, that's that tailwind that we're talking about when it comes to inflation and stagflation, because you're seeing PPI or producer price indexes explode up, especially in Europe. But the fertilizer is the biggest component, because when you can't feed people, that's when bad things happen. You just have to go through history to look at what happens when people don't eat, which is why food is such a huge component of Maslow's hierarchy, and you need fertilizer to get the yields that we're used to. And without fertilizer, you don't get the yield. If you don't get the yield, you don't have the bumper crops. And we haven't had a bumper crop in a long time, which is why we're in such dire straits when we look at the food side. We talked last week in both segment 1 and segment 5 about the food shortfalls that are hitting China, the Yangtze River, lowest level since 1865, huge amount of farming that happens there. Go back, please watch segment 1, segment 5, learn more about that, because there is a lot to come when we're looking at food. And then we do cover it again in this week's Insights, adding some additional color to what's happening in that market. Now, when you start turning to the U.S. and some of the recent data, who expects workers to stop getting raises without a recession, percent of workers receiving no wage increase. You're seeing that there's been a drop, but it's based on what we're starting to see from the recent data, that's increasing, where costs are going up, still staying elevated, and as wages start to drift lower. And again, it's going to be a drift. It's not going to be this huge shift up. But that's where you're going to see some of these pressure points. But as people still expect raises, that's in labor is an input cost, which again, input costs go into how companies are going to set their pricing, keeping that inflationary tailwind. Kansas City Federal Reserve, significant slowdown. Manufacturing index at 3 versus 10. New orders fell deeper into contraction. Shipments contracted by 13. Production fell to 9. So again, you're seeing a lot of these slowdowns that we've been talking about, and this is what we had been referring to when we were discussing Richmond, Chicago, and New York in yesterday's show in segments 2 and 3. But it's when we look at the commentary coming from Powell today, when you look at rates, when you look at the view where rates and his comment is rates are going to be higher for longer. And that's what we've been saying. The market has been saying, oh, Powell's just kidding. He's going to cut rates sooner. He can't tolerate this. But when you look at inflation, you look at sticky inflation, you look at the PCE that came out today, which is obviously going to continue to go up. And again, it's going to continue to go up because of electricity prices, because of natural gas prices. So yes, gasoline is coming down. But where's heating oil going to be? Where's electricity going to be? Where are all of these other inputs going to be? So when we look at PCE deflator, it was expected to be flat, came in at negative 0.1. So again, this is that stagflation. It's not really down. It's small move lower, but you're still getting that elevated level, which is why when you look at what has happened in the past, and when you look at Burns in the 70s, and then again Miller in the late 70s, there was always this error where inflation started to improve, so then they cut rates a little too soon, reinvigorating and sending things back to the moon and creating a wage rising spike, a wage spiral. And it took Volcker to gun rates and to get things down. But again, they also don't want to have to gun rates aggressively. So one of Volcker's comments was, if he had gone slower, maybe he could have stopped at 19 instead of 22. And when you look at Powell, if he were to slow down now, you would risk having to then reaccelerate again. So let's just go up 50, 75 basis point hikes, get to a point, see where things are. And again, we do believe we see 4%, maybe even 5% in a fairly short period of time, because inflation remains elevated. Quantitative tightening needs to come through. We've been easing since 2008. Obviously we had the reacceleration in 2020, and now it's a matter of taking some of this out of the market. But as this is happening, you have to look at what is obviously the fallout. And the Kansas City one, just going back to that for a moment, you're seeing, again, the economy is not in a good position. And this is the error that you make if you leave things loose for too long. Because there's no reason why we weren't tightening in 2021. The world was getting better. We were reopening. Things were starting to move about. Inflation was already starting to move. Why was the Fed buying mortgage-backed securities? Like, where in the housing data in 2021 did you see there was a need for support for housing? And these are the errors. These are the problems that we come through. So now inflation has a huge head start. Sticky inflation has a huge head start. And that's where we're going to continue to see a lot of this fallout. Total card spending per household, excluding groceries, gas, and clothing, by income group. You can see that people are relying more on their credit cards. What we've been talking about, it's obviously shrinking in July versus May, as people are trying to not use as much. Credit and debit card spending per household for those with annual income above $125,000 has contracted on a month-on-month basis for 3 consecutive months. And again, those are the big spenders. Those are the ones that typically spend the most, and they're now spending a little bit less. And people that below 20,000, they're relying on credit more and more. And again, that's something that we think is coming to an end. When you start looking at some of the ancillary data sets, buy now, pay later, some of those delayed payments, you'll be shocked to know that this past month, it's the most that they haven't been paid, or they've been delinquencies since the beginning of COVID, which is obviously when the floodgates opened on the fiscal and monetary side, kicking off in March. U.S. personal income, July personal income was expected to be up 0.6. Instead, it came up 0.2. Prior month, it was up 0.7. Personal spending was expected to be up 0.5. Instead, it came up 0.1. So when you adjust this for inflation, they're both negative. So income was negative again, not keeping pace with inflation. Personal spending, negative again, not keeping up with inflation. Again, all of this is showing that you have these headwinds going into a rate rising cycle that really can't be stopped. It can be slowed, and the rate of change can adjust, but the ECB and a lot of the developed world, including the U.S. Fed, the Fed and the ECB, were so late to the game. ECB way more so, as we talked about in segment 4 of yesterday's show, and that's going to keep a lot of this pain going through. Then July PCE declined month over month for the first time since April 2020. Core was at point, but then when you think about it, core was at 0.1, not 0.2. So even as the total, which includes obviously gasoline, which as we know, gasoline prices came down in July, huge mover down. Core, when you take out energy, it went up. So yes, the rate of change slowed, but on a core basis, the sticky piece continues to go higher. Yes, it's slowing down. Yes, it's not going at the same level, but that's what we talked about, stagflation. These are stagflationary numbers. And that's where, again, as we have stagflation coming in, then you add in electricity prices, you add in heating oil prices, you add in all of these broadening shortfalls. That's inflationary. You're going to have supply issues. You're going to have availability issues. And again, this is where we continue to see
why this is similar to the 70s, why this is going to be a weird amalgamation of the 30s and 70s in terms of what this contraction looks like. Then when we look at the regional Fed side between the Richmond and Kansas regional, you see just kind of where the current manufacturing composite is. On the Richmond front, -8, Kansas City at +3, but the trend is down. And I want to wrap up by saying, even as all of this slows, because of the structural shortfalls that we have at the market, you're not going to see spread counts come down. And that's where it's going to be a nice change of events if you want to think about it, for those that have been sitting in the energy industry and just getting beaten up constantly. It's that there is a broader shortfall. And this is, you can talk about oil, you can talk about OPEC, non-OPEC, Iran, no Iran. I want to talk about natural gas and liquids, which is really where the U.S. can shine, where the U.S. is really taking hold. There's a shortfall, not globally speaking, but also in the U.S. when you look at where we should be versus current. And that's going to provide a lot of uplift for companies that have gotten beaten up. I am a natural gas E&P, beaten down bull. And now you're starting to see you're in a position that we haven't seen in a very long time. And these companies are just starting to come about. And that's where we need to incentivize them. We need to see them get back to where it is. But where's the pipeline capacity? Even as they increase production, there's a lot of LNG capacity that's currently available, and more coming online with Golden Pass and Port Arthur. So again, you see this backdrop where we're in a position to not only answer the call in the global market, but also generate returns for shareholders in the U.S., which is something that would be nice for a change for the energy industry. So that's what we have for you today. Hopefully that was a strong recap of some of the interesting things that we've seen, and obviously the primary vision frac spread count. So if you have any questions, please reach out to us in the comment section, by Twitter. I still have some emails to respond to. I apologize for the delay. But again, as always, thanks for watching and have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.